Imagine the markets fell by 25%. Two investors who've built the same amount of wealth. One remains invested, but the other is forced to sell. What difference do you pick straight away? Liquidity. During periods of uncertainty, liquidity becomes one of the most valuable characteristics of an investment. Today in Signal episode 35, let's explore what liquidity is, how investors can assess it, why it deserves just as much attention as investment returns, and what level of liquidity is appropriate for various stages and circumstances of your life. Because while investment returns build wealth, liquidity gives you the power and freedom to choose. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. Nobel Prize-winning economist Myron Scholes once said, "Finding an umbrella in a rainstorm might be impossible or very costly." His point was simple. The actual time to think about liquidity is not when you need to access it. Just like the umbrella, easiest to be bought before it rains, liquidity is easier to plan for or build before uncertainty arrives. Liquidity is simply the ease with which an asset could be bought or sold quickly at or close to its fair market value without significantly affecting its price. The key point to be noted or understood is liquidity is not fixed. It's a continuum, and each asset occupies a position on that liquidity continuum from being highly liquid to less liquid, and this position changes as market conditions change. Now let's look at how can investors assess liquidity. 4 key questions will help us understand that. Firstly, how many buyers and sellers are there? Secondly, how frequently transactions occur? Thirdly, how easily can a mutually amicable price be agreed upon between buyers and sellers? And fourthly, will a large transaction materially impact the price? The stronger the answer to these questions, the more liquid the investment generally is. Some investments can be converted into cash quickly with minimal impact on their price, whereas others may need more time, more negotiation, or even acceptance of lower price. At the highly liquid end of the liquidity continuum sits cash. It's immediately available, requires no buyers, and can be accessed at its full face value. Moving along the continuum, listed ETFs and large cap shares are also highly liquid, supported by frequent trading and large number of buyers and sellers. Further ahead are open-ended mutual funds. Investors can typically redeem units on any business days, making them relatively liquid. Although the benefit received or value received depends on funds' prevailing net asset value, and settlement can take few business days. Physical gold also sits towards higher end of liquidity, particularly widely accepted bullions that can be traded quickly by established dealers. Towards the less liquid end of the liquidity continuum sits thinly traded shares, residential properties, and private businesses. Transactions typically take longer and greater negotiations before they are completed. As stated earlier, the important point to note is that the liquidity continuum is not fixed. Market conditions change, demand changes, and during market stress, even highly liquid investments can become less liquid. Liquidity provides flexibility. It allows investors to respond to unexpected expenses, rebalance their portfolios, take advantage of new opportunities, and avoid selling long-term investments at wrong time. It has been observed that for many people, liquidity becomes a consideration only at the time of sale of an asset. But by then, it's too late to determine and influence liquidity. During market corrections, liquidity can become your greatest strength. It provides you the flexibility to remain invested. And if your long-term investment thesis has not changed, then it gives you the confidence to buy quality investments at lower prices. Liquidity is built during good times, but it proves its value during bad times. The appropriate level of liquidity depends on your age, income, financial commitment, investment objectives, and your tolerance towards uncertainty. Someone approaching retirement may choose to maintain higher level of liquidity compared to someone who's investing for goals that are decades away. Similarly, an investor who's expecting a major financial commitment in near future may want readily accessible assets compared to someone who does not have an immediate cash requirement. The right level of liquidity is the one that supports your financial plan without forcing you to make investment decisions under pressure. And this is where a SEBI registered investment advisor can help. They design a portfolio that balances long-term growth with appropriate level of liquidity so that your investment plan aligns with your financial commitment, cash flow requirements, time horizon, and risk tolerance. Before I go, I would like to leave you with this thought. The true value of liquidity is realized during uncertain times. And that's precisely why liquidity should not be an afterthought. It should be a key consideration when making an investment decision. So the next time when you're making an investment decision, ask yourself, if my circumstances were to change, will this investment's position support my needs on liquidity continuum? And remember, liquidity is planned and built during good times, but its true value is revealed and realized during uncertain times. Returns build wealth, but liquidity gives you the power to choose.